Hello and welcome to December's SFI Not So Live with me, Jay, your host. Got a stellar panel today, but a completely different panel. Tony's still with me, which is a bit of a shame. No, he's got a bit of a hangover today, so let's be gentle with him. So Tony, good to see you this morning. How are you?
I'm very. I can't even speak. I am very well, thank you. I've struggled even with that, so I'm well, thank you. There we go. Let's leave it at that.
There we go. We all know who Tony is, but if you don't, Tony's the head of business development at Saffron. I won't let him go any longer. Let him have a bit of a break, so I'm going to expect him to talk a lot. We're also joined by Tony's colleague, Debbie. Debbie, nice to see you on the podcast, or hear you on the podcast, I should say, really. Welcome. Just a little introduction in case anybody hasn't seen you before, Debs, please.
Yep, so I'm currently the manager of the intermediary team. So I look after the telephone BDMs and the business development assistants. So we're the people that will take your telephone inquiries, take your live chats and take your emails. And we're there to help you, really, for all brokers that need any kind of assistance.
Debbie, we're going to call you for the
Mummy.
Mummy Debbie.
As long as it's not grandmother. As long as it's anything more than mum, I don't mind.
And our special guest for this month, absolute joy to introduce you to Steph from Alexander Hall. Steph, good to see you. Do you want to do a little introduction for the audience because you haven't been with us before, please?
Morning, yes, thank you very much, Jay. So Steph Daly from Alexander Hall. So I am the Director of Partnerships here. So Alexander Hall, we are London-based intermediary firm. And my job essentially is to do all of our third-party relationships. So all of our lender partners, all of our tech partners and any other third parties or partners that we work with all goes through me. So great to be here.
Lovely to have you. Thank you. And for those that are joining us for the first time, SFI Not So Live is all about the property and mortgage industry. So we're looking at what's going on with the mortgage market. It's December 2022. So anybody remembers back, if you're listening in the future, will remember what a turmoil we've been in the last few months. There's always lots to talk about. We're going to pick up some of the stories that have been in the trade and national media and just pick them apart a little bit. We might have different views to what the story is. But just to caveat, these are our personal views and not necessarily that of our employers. So I would like to say that now. And everything we discuss is right as of, what day is it today? The 25th of November, 2022. Okay, so let's crack on with our first story. It's from Mortgage Strategy. And the headline is NatWest lifts 5-year buy-to-let loan and remortgage stress rates by 35 base points. Tony and I have had a conversation with this. So, Tony, I'm going to come to you first. But so NatWest have upped their buy-to-let stress rates from 4.75 to 5.10%. Tony, this is going to affect renters, isn't it? Because are we not going to see landlords putting up their rents now to combat this and to affect this? And what's it going to do to the rental market?
It's a challenging time for the buy-to-let market all around for landlords. This story's kind of slightly outdated because there are lenders that have tweaked their stress rates down on buy-to-let. So there's some, this one here. Now, the biggest thing is, affordability for portfolio landlords and landlords in general now with increased affordability on the calculations is going to be a struggle for some. So the impact of that will be ultimately rents increasing for a number of tenants. But I think the other thing is you might see the non-portfolio landlord getting rid of the properties and actually creating opportunity in the market for portfolios to pick up even more, but also for first-time buyers and to get on the ladder as they divest these properties because they're just not worth commercially keeping. So I think that's what we're kind of facing with this, particularly joined with the tax changes going to happening to capital gains tax. So in the next 3 years, it's tailoring down from where it is to virtually nothing. So there's virtually no tax relief for investment gains. So I think you might see a lot getting out now. So there's a lot of uncertainty in that market, plus regulation on the whole energy efficiency as well. So it's an interesting time.
Seth, from an industry-wide perspective, sorry, Tony. Steph, from an industry-wide perspective, are we seeing a downturn in buy-to-let inquiries, or is it still as buoyant as it was? I mean, the last story we only did a story a month ago saying buy-to-let inquiries were in the increase. How is it looking at the moment?
Yes, so from our side, what we there are still a lot of people sort of talking to us, of course, about buy-to-lets, and different types of buy-to-lets is more of the conversations that we're having. So be that limited company so that you get the slightly lower stress test, or those clients who are looking to get the higher yield. So on the holiday lets, potentially student lets, HMO. So we're seeing a lot more of those inquiries. This 5.1 that NatWest have referenced there, I mean, now a lot of lenders are stressing a lot higher than that. I think that article was back in September. So it since then it has got a lot worse and a lot harsher for certain landlords, especially in the remortgage space. It's really difficult to get the rental calculations to stack up. So I think industry-wide, we definitely do need more innovation in terms of like top sizing and using full affordability, really to get the calculations to work. But as Tony said, landlords have been hit significantly harder over the last period of time with those capital gains changes and the income tax changes. I 100% think that landlords will pass this on to their tenants because they simply just have to, because there's no other way that they're going to be able to survive. I think I was reading another article, and rental inquiries are up about 23% compared to where they were this time last year. So there are a huge number of renters in the market looking for property, and there's not as much rental property on the market, whether that be because landlords are pulling out because of the EPC issues, or because they've already locked into previous rental contracts. I think year on year as well, rental values are up. It's about 12% or so. Although they are up, it's still not far enough up for the new rental stress calculations to be able to be hit. So it is a really difficult time for landlords. And so looking into that innovation and different types of affordabilities, I think, is where we need to go.
Thanks. Just to you, Debbie, something that Steph just mentioned, a limited company buy-to-let. We entered that market last year. Was it last year or the year before? Time flies, doesn't it? Have you seen the increases in limited companies? Has that swayed the applications from an individual to limited company applications?
We haven't got a limited company product at the moment. So we haven't got any inquiries that are coming in for it. So we do get people who are calling up about the product. We haven't got it. We launch it again hopefully in the next couple of weeks. We get inquiries from brokers who are talking about our stress test, because we are able to apply 125% of stress if it's a pound for pound remo on a buy-to-let. The only products that we have on the buy-to-let at the moment are buy-to-let like refurbishment and expat products, although we are now steadily bringing back other products, and there's more that are coming back week on week. So we are launching back into the market across all of our product range. But certainly we do get, and we had in the past, get buy-to-lets from limited company buy-to-let landlords, because we didn't have a restriction on SIT codes, whereas other lenders did. So, but the buy-to-let market is tough across all lenders and across all landlords at the moment, like Steph and Tony both said. And I do agree that I think the rises are going to get passed on to the tenants. Landlords won't be able to absorb it; they will pass it on.
Of course,
they're not going to be able to say that, oh, we're so nice and fluffy, we're going to absorb this ourselves. They've got to pass it on. That's why they're doing it, for the purpose of making a profit. They're not doing it otherwise.
Exactly that. I think, as Tony said in his comment, it's going to see a shift. Just not to recommend another podcast, but I'm going to. If you ever get a chance to listen to the News Agents podcast with John Sopel, Emily Maitlis, and Lewis, all from Newsnight, last week they did a feature on the rental market. It's well worth a half an hour listen. It was so intriguing. They spoke to estate agents in London. It was interesting to see how the rental market was going. So if anyone's interested, hop over and have a listen to that. Tony, the reason for this story is because we talk a lot about stress rates at the moment, aren't we? In fact, on your residential products, haven't you just done a little drop, Tony? Blatant plug time.
Yes. No, we have. It's kind of been in the rounds of. So when we were looking at updated the ONS figures, which is the data we use for our affordability calculator, and to be fair, probably 90% of the market uses it. we were adding in the additional costs for utilities and cost of living rise. And obviously that made quite a material impact on the affordability. So we looked then at the stress rate, and then looked at the regulatory change in August, which allowed us to consider that stress rate. So the decision was made that we would reduce that stress rate from 3% over our SVR prevailing rate, follow-on rate, to 2%. Now, what that ultimately means is affordability is still going to be tighter for everybody, but we've just not made it as difficult by taking that 1% off. So we've tried to kind of balance the seesaw, if that makes sense. It is still tipped towards a lesser amount for in terms of maximum loan, because that's the responsible thing to do to reflect the changing cost of living. But what we've done is, and I think we are probably the first lender in the residential space to do that, I believe, try to balance out the stress rate with the new rules and the increase in income. So yeah, we haven't made it so it's you can get more money. We've done it to try and balance out that you're not massively affected by that increase, in effect.
That's fair. And I think it's important to remember that this is responsible lending, isn't it? And there has to be a stress test there. You can't just wipe it out. Although the Bank of England made a decision to remove it, it's not for the lenders to do the same thing, is it, Tony?
No, it's not. And the stress rate's been in situ across the industry since 2014, hasn't it? And I think in this environment as we're heading into now, I think that was proved an extremely sensible decision to make, because the interest rates that people are being stressed against in terms of their ability to afford have been such a good buffer. That's why I don't think we're seeing the payment shock, as in it's going to be a shock, people's payments going up, but the impact of not being able to afford the mortgage, I hope, isn't quite as bad, because we have been stressing at this increased rate for a number of years, not just us but the whole market. So it was a sensible thing to do after the crash and the fact that there wasn't stress rates.
Mm-hmm.
So
this,
it's the right thing to do. But
this is all related to the cost of living crisis, and we're going to come on to our next story in a minute, which will kind of counter some of these stories. But Steph, just from your perspective, looking at the industry and looking at applicants and looking at what's going on, do you think that the mainstream media's perception of the cost of living crisis is dramatised? Because I'm having mixed conversations with people who are saying, actually, bars and restaurants are still full, people are still out. Are we actually feeling it yet? Or actually, are they scaremongering to prepare us for coming in April? Because I can't see a huge slowdown in the market. Am I wrong?
Yeah, I 100% agree. So I think there's a huge amount of scaremongering in the press, which is making things worse, essentially. So it's the press telling people that they can't afford to go out and have their dinner out or a couple of drinks after work, etc. And that will then just escalate the problem. So if people think or believe that their energy bills are going to be going up by sort of £2,000-3,000 a year, then maybe they will start making cuts. But it's those people who can still afford the higher cost of living. Those people still need to be going out, spending money in their bars, going out to eat, etc., because that will then support the whole hospitality industry, and every other industry that we need people to be able to support for the wider economy. On stress tests in particular, certainly over the last few months, I've had a personal annoyance with the press, because there's been a huge amount of stories talking about lenders stress testing residential mortgages sort of 7-8%, and how much of an impact that's going to have on people. And realistically, lenders have always been stressing residential mortgages at 7 or 8% or so. It's just perhaps it wasn't publicised before. So there's always been that level of responsible lending. And since August and that stress test removal, or the rule changed, of course, a lot of lenders didn't immediately change. Obviously, every bank has their own policy. Some lenders have since increased their residential stress test for certain types of clients. And typically I'm finding that's hitting potentially those clients with like children or background properties more. So where you look at the residential stress test and the loan to income cap, I think both of them together are sensible, but of course there does have to be some overall just affordability view. I mean, we're doing budget planners. We've been doing budget planners for years on clients. That's all working sensibly, and I think we've got to let people manage their money in a way that they know how to manage their money, and not just listen to the press articles and get scared and then change the way they are spending money, which will then have wider economic impacts.
I find it absolutely amazing that they're spending 20 odd million pounds telling people how to cut the cost of their energy. Can't they just feed that back in and give us some of it back? Because people know, and there are other people who can do that for free, spending tens of millions of pounds to push that message into people's homes. It seems like, I mean, this is my opinion. Sorry, let me just put that out there. This is my opinion, but it seems like the government and the press together. I'm a PR person, so I'm not dissing the press, anybody listening. But the press and they do generate this in order to make us change and do things differently. But my view is that we're not at the worst of it yet. That's probably going to come in April when, you know, we do get less support for energy and people are really going to start to see it. So I think there is some preparation for what's to come. But I'm not adding to that because I'm going to go to a positive story that I think does completely, step all over that. And it's from Mortgage Solutions and our friend Shakina, actually. So Q3 gross mortgage lending is up by a fifth from the Building Societies Association. Now, I believe them over the mainstream media any time of the day. So, we've seen an uplift year on year, Q3 of 20%. So, Tony, that doesn't scream to me that the industry is shutting down through a cost of living crisis. People are still moving and shaking and doing things. But are we in the last of that before we go into New Year?
Yeah, look, the market, I mean, Steph's even better placed to answer this, but the market is definitely cooling for purchases. Yeah. I know these figures are good because these are all going back 3, 4, 5 months. Don't forget, because that's the completion time scale. So this is all the activity from probably the summer and maybe even late spring, because we know that completions have been delayed, but they're actually firing through at the moment. So I'm expecting an even bigger Q4 actually, because we're seeing our pipeline really start to motor out the door as people want to get into their new homes. So the market's definitely slowing for purchase, but the product transfer and remortgage markets are huge, and I think that's going to be the big thing for next year. And I think probably let's let Steph give us her view on that, because she's far closer to it than I am.
Go on, Steph, off you go.
Yeah, so I mean, we are seeing this the same. So there has been a massive shift in terms of the product transfers and the remortgage. Obviously, from the lender side, that clearly is a big focus for them going into 2023. So a lot of the product transfer windows have been extended, which has been positive to see. Certainly from a broker side, anything that we can lock in a client early on a rate, get some security, has been very, very positive. Obviously, where that's been in a rising rate environment, that's worked out really well. At the moment, we're now in a position where rates are starting to come down, which I know we'll speak about later. So now essentially we're looking at those product transfer deals or remortgage deals that we have done in the past and seeing if they are still the best options for the clients. So that's then, of course, going to have a bigger impact in terms of if we're having to resubmit cases. So from the lender's side, that's you're going to have to be redoing a lot of the work that you've already been doing, which I know will come with its own servicing issues as well. But for this article, what I particularly liked is that it pulled up about the building societies in particular and the gross lending for them. And I think that just shows the shape of the market over the past period of time. As I say, these are deals which were submitted early 2022. So I think from the broker side, definitely we're looking away from just those high street options. So we're needing to get slightly more specialist solutions, whether that be using different sources of income. So over the pandemic, we've seen clients perhaps taking on second jobs or changing to self-employed, maybe have a smaller, only 1 or 2 years self-employed. So being able to use the building societies who actually have the options available for those clients has been fantastic. And as well, certainly in sort of the past period of time, so the last month or so, it's been those building societies that have been pricing actually a lot better than those high street lenders as well. So there's a shift towards those discount variable products as opposed to just looking at the fixed rates. So from a broker's perspective,
sorry, Steph, I was going to say, do you see the more flexibility from the building societies than the mainstream, i.e. quicker to turn around? Obviously, with the market the way it's been quite volatile, but in my opinion, and it's only my opinion, I'm not an expert, but I see building societies reacting much more positively and quickly than you would perhaps from your high street lender.
Yes, they are. They do definitely seem more agile and able to move because they're not such a big juggernaut as sort of your top high street lenders. So they can be a lot more agile in terms of what the criteria and the processing and the underwriting powers that they have. So they can adopt a lot quicker, which is good to see.
Deb's just coming to you, Debbie. The second paragraph of the story actually starts about approval levels, and they have dipped. Now we're kind of expecting that, but as Tony was saying, we're looking back a few months. But are you seeing that? Are you struggling? Is there a real impact to borrowers at the moment? And do you think that we're only seeing the start of affordability issues and approvals being hit?
I think approval levels haven't necessarily dropped. I think that that brokers need to be more mindful when they're doing dips that they include everything in the affordability calculator, and I think they need to make sure that when they're doing the applications that they check the bank statements and things like this when they're actually providing the supporting documents. So there's cases that we've certainly seen where applications are going through possibly when brokers are aware that rates are being pulled, that the cases are submitted very quickly where documents aren't necessarily being checked as thoroughly as they should have been. So there's a kind of a panic on, I know that I've got to get this case in, I know that I've got to get the rate secured, so I'm going to submit the case as it is. Documents aren't thoroughly checked. It's then going through to application, and then the cases are being declined because the bank statements don't support the initial dip decision. So there are things that are found through the due diligence checks that the underwriters do, where payday loans or gambling, for example, is found on the bank statement. So then cases are then declined on the back of it because the documents haven't been checked thoroughly. Affordability will be an issue if, when we go back to things like the affordability calculator, where things are then left off. Not on the calculator, sorry, on the actual income and expenditure form. So as Steph said, brokers are very good at doing income and expenditure forms. Sometimes they're not as thoroughly completed as they should have been because, there might be the form, how much you're going to spend on food isn't quite accurate. How much you're going to spend on bills isn't quite accurate. And the underwriters look at it and say, I just can't get the case agreed because it simply isn't affordable. It's not responsible lending.
To be fair, half of us don't know what that's going to be in a month's time.
I know, and that's the problem. That's the problem. We don't know what it's going to be. So if there's a case where the amount selected for how much you think a bill is going to be isn't quite accurate, then the underwriters have to take the decision. It's not responsible. But what we do as a team, as part of what we do as my team do, we go through all of any declines that are automatic, for example, and we double check them all to make sure that the decisions we think are correct. So we don't just look at automatic declines that go through the system to say, oh well, there's been an automatic decline, let's just leave it at that. We double check all the decisions that go through just to make sure that we're happy with any automatic declines. Because they could be that there might be ones that we actually want to challenge. So we don't just accept a decision that an underwriter might have given. We might challenge it if we feel that it's not correct, or if we feel that criteria might have been applied incorrectly. So we're a building society that not only do manual underwriting, but we, as a BDM team, we are quite very good at challenging decisions. We don't just let it go. We will do what we can to make sure it goes through. And we don't always win it because the underwriter is the one that has to put their name on the paperwork to say whether it's accepted or not. But we certainly challenge decisions that we feel are wrong. And we certainly challenge automatic declines that are based on affordability, because we need to double check that the affordability calculators are always working in the way that they should be.
And I think it goes back to what Steph and I were talking about with regards to the difference between the sort of mainstream lenders and the building society sector is this common sense manual underwriting. Let's look at everything in detail rather than an automatic, oh, no, you declined. So there is some flexibility, and we like that. We like common sense lending, don't we, Tony? But Tony, let's face it, the one story in the media that is true is we have got a lot of remortgages needed. There's a lot of people coming off their fix and looking for new products, and that's now and for the majority of next year where we're going to see this market try and balance itself back out. So there's going to be lots of people in very difficult situation next year compared to what they were in this year.
Yeah, they are. There is going to be a lot of people who've never experienced an increase in their mortgage payments, and quite a marked increase in their mortgage payment because the rates have gone up so rapidly. So yeah, but I think I would that's why people should go and see their quality broker, because they will do the right thing for them. They will find the right product. They will tell them whether it's worth them remortgage to a different lender or staying with their existing lender. So just for any consumers listening to this, just go and speak to your broker. It never has been more important to get quality advice. Do the right thing. It's going to be more expensive. We can't hide from that, but let's make sure you're going into it with your eyes really wide open.
Steph, we're going to talk rates in a second, but I won't go on to the next story just yet, because we had a conversation on the last podcast about the rise in the take-up of variables because they are a little bit cheaper than where the market was sitting. We might be able to counter that slightly. Did you see that across your network, across your customers? Did you see them taking up more variables and having more engagement with them than before?
Yes, definitely. So, I mean, I was looking at products yesterday, and some of the variable rates or the tracker rates are about over 1.7% more competitive than the 2-year fixed rates, for example. So especially where you've got products which don't have early repayment charges, or you've got the flexibility there, it's definitely something that's worth a conversation and a consideration. Of course, we've got to be looking at what forecasts are for future base rates increases, although they tend to change on a month-by-month basis. So really, it's just making sure that we actually are having full holistic conversations with clients, future plans. How could are you comfortable with higher potential monthly mortgage payments in the future? How would that affect you and your monthly outgoings, etc.? So that is 100% an advised process. And I think what a lot of consumers do who don't talk to an advisor, they miss out on these trackers and variable products a lot, because you don't tend to hear, people don't talk about what types of mortgages they've got in the pub or wherever they're talking to their friends and peers. So when I know that certainly when people are looking online, money supermarkets, etc., it tends to be the fixed rates that people look for because they're the more publicised ones. But that's why definitely having a conversation with an advisor just to speak through the pros and cons of each, what they actually mean, what does it mean if you've got no early repayment charges, what are the actual impacts of that. If your interest rate were to go up by 0.5%, this is what your additional monthly payment is going to be. Is that comfortable for you, etc.? That's exactly what an advisor can do, and that's not what a chatbot or a website can do for you. So definitely we're seeing more and more of those conversations.
That is cracking advice. And I love your comment about don't talk about it on the pub. I picked up a saffron customer through a broker yesterday in Greg's. No word of a lie, I had a steak bake in my hand. I had a conversation about mortgages, self-employed person. And it was one of those bizarre conversations you just have. And I was going, oh, no. And I was like, why do I know this stuff? Obviously, it's you guys get feeding me the information. But yeah, no, I agree. I think, before I started working with Saffron, I was in the industry. I didn't know much about variables. Tony will tell you I was completely oblivious to them because you do only read and hear about fixed rates. So yeah, big advice. I know most of this audience is brokers, but any consumers, listen to Steph and Tony. Go and see broker and Debbie. Okay, on to our next story. We don't.
Yeah,
very rare. Sorry, Tony.
Sorry, Jay. Oh, I was just going to come in and just on that point. So if you look at the sourcing systems, there's a really good balance between fixed and trackers and discounts, and even so that the big banks are now looking at their strategy for discounts and trackers. So it isn't just the building societies. Everybody's realizing that this is a real opportunity to help those who can afford to take that hit if it happens, but get a lower rate for now. So it's a really encouraging sign. And as Steph says, it's another good reason to really get that good advice.
Thanks, Tony. So yeah, as I was just about to say, I very rarely pick up a BBC story to put in our story list, but here it is, because it's nice. It's a nice story. It came out just yesterday. It's been updated yesterday. 5-year mortgage rates are back below 6%. That's a nice thing to hear, isn't it? So let's just pick that apart just a little bit. The average 5-year fixed mortgage rate fell below 6% for the first time in 7 weeks on Tuesday, and we made that on Wednesday. The final information. So that's from Money Facts, just to say where that data has come from. Ever since, whatever you want to call it, Trussonomics, what was the other one? The quasi-Quartang version, I can't remember. But since that and all the volatility that happened with the mini budget, this is a sign that we've calmed things down. The autumn statements happened. Steph, I'm going to come to you first. Is it calming down? Is this an across the board? We're now looking at, we're going below that 6% mark again, which will please a lot of people.
Yes, so we are pretty much daily, we are seeing about 3 to 4 emails from different lenders with rates being reduced, which is obviously absolutely fantastic to see. Those are the sorts of emails that I like to see hit in the inbox. What we generally do see is when reductions come, perhaps they're not immediate. Sometimes they're happening in a couple of days. So obviously you've got to do right by the client and then wait those few days to get the mortgage applications in. But I think across the board, especially where, as Tony mentioned earlier, like a number of the lenders have already hit their lending targets for 2022. They're wanting to get the applications in now because this is what's going to kickstart the 2023. So where we're looking at pricing and a number of the high streets and the smaller building society lenders coming down, it's just fantastic. But again, from the product transfer and the remortgage clients, that's where we're then from the broker side having to go back and look to review the advice that we've given. Is this still the best product for you? Could we get something potentially more competitive now? So it's just making sure that we're keeping an eye on all of our clients and all the products that we've chosen to make sure that they are still the most competitive for them.
Can I just pick that apart a bit with you, Steph, actually? Just what you said there about things changing. They're changing very, very quickly. We talk about this a lot on the podcast, on our webinars. We talk about how it's changing so quickly. It must be making the broker's job really, really difficult because you just said there, you recommended your product, but that product might change tomorrow or even this afternoon. We don't know. It's so quick, isn't it? How much grief has that put on the broker's shoulders? It must be very stressful for the broker community.
Well, especially in a market where the interest rates are reducing, because it means that you have to keep such an eye on every application that you've already submitted. Where we had the opposite problem and we knew that rates were increasing, it was essentially easier for the brokers because the onus is on the client. These are all the documents that I need. Get them to me. You get them to me. I'll submit the application. I'll lock the rate in. And I know that that's going to be the best rate because I know that in 2 or 3 weeks, it's likely that those interest rates are going to be higher. So it's really now the conversation is let's just get something locked in so that at least we've got something secured, but we can always review it. But of course, in a decreasing rate environment, the urgency on those remortgages and product transfers isn't there. So where a number of lenders have now moved to 6 months out for their product transfers, which is great to see. But in a decreasing rate environment, it's not as essential as what ideally they would have done that sort of last year, but it's good that we're in that position now anyway.
Tony, can I bring you in on that from a lender perspective?
Yeah, look, we sit there quite often because we're relaunching products again and looking at where does the market sit and where's it going, and it is still quite hard as a lender to price effectively. To try and price at the margin you want and to get the volume that you want that maintains the service that you want to provide is a real challenge at the moment, and it's a fine, and that's why you'll see some lenders bringing products in and then taking them out quite quickly because it's quite hard to get that mix right. But there is some way, I personally believe, for rates to drop. Swap rates have settled down. The rates are probably not are higher than they should be in the market if you look at the cost of funding generally, but it's going to be the brave lender that brings it down to probably the level it potentially should be at, because that lender's then going to get absolutely bombed with apps, and there the cycle starts again. So it's a real balance. But I think encouragingly, it's great to see rates coming down. I think we've got a dash of realism and realise that that very low interest rate environment is not here in this cycle. We're in a higher interest rate cycle, but we're nowhere near the higher interest rate cycles that we've been in before. When you look at, I think we might be talking about it, but one of those charts showing what base rate was back in the early 80s at 18%, and then the spike in 1992 when it went up to like 15% again. So we're nowhere near that, and I don't think we'll see that again. So it's a good time. It is a challenge for lenders to get the blend right. It is still weird to me that 5-year money is cheaper than 2. But that's a promising thing, because it shows you that we've got a short-term challenge and a longer-term smoothing, which is good. So that's encouraging, and it's great for people who want that longer security, And I think what you will see is far more even longer-term fixed rates coming. We I don't know if we're talking about this later, are we? About the length of term of a fix. Because
we're not. I don't think we are. So feel free to continue that bit of your conversation, because I don't think you've reached our story. So carry on.
As a nation, we think 5 years is a long time to fix a rate, and that's kind of it. And there's been a spattering around 7 and 10, and you've got some lenders coming in showing the 30-year term. But that's the standard in the US and in Europe. You get a fixed rate mortgage for the term of the mortgage, which actually, provided it's got some clauses to get out of it without, huge charges for doing so, it's a really great thing. So I think you'll start to see perhaps more innovation around that to stop this worry. So that's, I think we've got...
If you remember a couple of podcasts back, Tony, we had Simon on, and he was gloating a little bit with everything that's going on, because he took a 10-year fix, didn't he? And he's a young man, but he said, well, look, we're not planning to move. So actually, they're planning a family, I think, aren't they? So, they've got no intention of moving. They've got the house they wanted. They're quite happy. They looked at the situation, went, yeah, let's go for a 10. Why not? And now they're sitting there thinking, yeah, well, so glad we did that at 2.1%.
Again, go and see your broker, because they will have that proper conversation with you.
Can't say that enough, can we? Go and see your broker. So I'm going to skip on, because time is running away with us today. We are having a very in-depth conversation. So I'm going to move really quickly on to the next story. Debs will bring you in on this one as well. So 2020, this is from Mortgage Introducer. Is 2023 the year of rent to own? Now, I've picked on this because it's an innovation. It's an initiative. It's different. It's come over from the US. But I wanted to open a conversation about what other companies, fintechs, whoever it may be, are doing to help people to get on the property market. Now, this story, just so everyone is aware, was paid for to be on Mortgage Introducer, but I've picked on it because it's just these new innovations, new ways that, and new things that people are doing to try and get people on the market. Now, do you think there's a home for something like this in the UK, Tony?
Yeah, there's definitely a need for this in the market. I saw this with interest and thought, yeah, that's a different way of doing it. The traditional routes are great, but are going to be more challenging for now with saving a deposit or enough a deposit. So anything that enables somebody to get on the ladder now rather than having to wait, if it's the right thing for them to do, is brilliant. There's loads of schemes coming in now with a Help to Buy going that do the same as kind of Help to Buy equity share, but are privately funded. So there will, they're not commonplace yet, but hopefully they will, and hopefully they'll add to the pot to make it even more of less of a dream and more of a reality for a lot of people.
Steph, from you on the same thing, this innovation, excitement, you've got a wider industry perspective. Good thing?
Yes, I mean, I think any innovation which will help the first-time buyer market is always good. There's definitely a lot more that can be done as an industry to support getting more first-time buyers onto the ladder, because I think we have been fairly spoiled over the past period of time with the Help to Buy. So that's been a sort of a fantastic in sort of easy enough solution to get those first time buyers on the ladder. But I think there's two main problems that first time buyer have. And of course, that's to do with your deposit and that's to do with your affordability. So some of the schemes, they are there that they have been helping with the deposit. So as Tony mentioned, those schemes which have your equity share help to boost the deposit, but the affordability issue is still there. What I liked about this particular article, certainly in terms of the rent to own, so reading the article, the rent that you paid, some of it went towards some of the equity in the property, and then eventually you would build up to 10% equity and then get a mortgage for the remainder. So, which as an idea, I think is great to be able to build up an equity using the rent that you're paying. I think there's a lot more which can be done there. So certainly where we have long-term renters who can show a history of rental payments at either the same level or potentially more than what their mortgage payments would be, as an industry, we should be able to do something to look at that proven history of affordability. In terms of this scheme in particular, I know that it referenced about different types of employments being able to enter the scheme. So those in the gig economy or maybe shorter-term self-employed who couldn't get a traditional mortgage. And sort of my question on this sort of scheme is that you're on it, you've built your 10% deposit equity in the property, and then they're expecting you to be able to go in and get a traditional mortgage. So we would then need a traditional mortgage lender to be able to support those who are employed by the gig economy or by the shorter term self-employed. So.
And Debbie, going to come to you on that as well, on the innovation side. Obviously, there are other things that are being done to help with, as Steph just said, the deposit and the affordability with things like JBSP, gifted deposits, all these kind of things. So there are things out there to do it. But is it not time we modernised a little bit in the UK? We are behind a lot of countries in our property and mortgage markets, certainly through innovation, especially in the US. The US seems to be having a bit of a surge of these sort of new innovations to help people out. So there obviously is a place for it, but there's also other things we are doing, isn't there?
There's other things that lenders will also need to look at, such as longer terms. There's the opportunity to go for a 40-year term with us as a society, but it might be looking at things like even longer terms for first-time buyers. People now don't retire at age 60 or 65. People now have to work a lot longer. So you probably end up working till about 90 these days. So,
by the time we get there, will be.
Luckily, I'm a lot older than you, so I can retire probably in about 10 minutes. So you've got people who might need to think about, going for a longer term because it could affect affordability. There are, other things. I mean, we certainly, when it comes to concessionary discounts, we'll take concessionary discounts from private landlords. So if you've got somebody who's in private rented at the moment and their landlord says, I want to, I'm happy to sell you this property at a discounted price, we'll actually take it from a private landlord, the same as we would do if it was actually from a parent, for example. But JBSP is a really good product that we have. A lot of other lenders do JBSP, but whereas it's different is we'll base the term on the applicant and not the supporter. So there's a lot of other caveats around JBSP. But the main thing, as I say, that's different for us is that the term can be based on the applicant. So if your supporter is, under age 17, immediate family member, but the applicant is only a 25-year-old, we can still do a 40-year term. And if your supporter is your 69-year-old grandmother, as long as it fits affordability, it doesn't matter that the grandmother's going to be 69 plus 40 at the end of the term, because the idea is within a 10-year period, we'd expect that grandmother to be a transfer of equity to get them taken off. But yeah, there needs to be a thought process from lenders about how we can help first-time buyers. Deposits now, I think there was an article, wasn't there, a couple of weeks ago about the average deposit now for a first-time buyer to be about £81,000. And there's not many first-time buyers who can say, yeah, I've got 80 grand and I can afford to do my own purchase. We were talking earlier on about interest rates being 18%. That's how old I am, that my first mortgage had an interest rate of 18%. But that was when property prices were a lot lower. Now, average house prices are so high that first-time buyers have got to come in at that market. And you need the first-time buyers to get the housing market moving. It isn't acceptable just to say, well, that's too bad, you've got to stay and rent it, because without the first-time buyers, you're not going to get that market moving.
I find it quite strange with a government that is all for starting a family, buying a home. This is a core message of the UK government, always has been, that things like Help to Buy would be removed and all these things that they put in. It's been so strange since the pandemic of all these things up and down, in and out. But actually, when you boil them down, half the initiatives they put in weren't worth the paper they were written on, because nobody actually took them up. But Help to Buy, Steph, is that a real loss to the industry?
Yes. So it's been, as I say, it's been fantastic in terms of supporting that first-time buyer market and getting them on the ladder. I know certainly over the past few months, the number of Help to Buy applications has decreased. I suppose it will be a huge loss to the developers as well, because now they have to be a little bit more innovative in terms of how they're going to make property sales. Although with Help to Buy, one of the drawbacks I did generally found certainly from the developer's side is, no matter where the property was in any London borough, if it was a 2-bed, it was 600 grand. So it'd be quite good to see developers need to change their pricing strategy and to be able to come up with potentially more schemes like the deposit unlock or any other types of schemes, first homes, etc., discount market share. So it is a loss to first-time buyers, but certainly I think generally we saw more potentially they're using the equity loan to buy a 2-bed rather than buying what they could have been able to afford, a 1-bed elsewhere. So essentially they've made that second step straight away. Be interesting to see, certainly in the new build space, how things change. But so there is a lot of schemes and there is a lot of conversations about what can be done to replace Help to Buy, but no magic bullets so far.
Well, in the last 20 years, I'm showing my age, last 20 years, the average first-time buyer age has shot up. I mean, most of my friends had a house by the time they were 25. I was a late developer because I lived in London, so I was never going to be able to afford anything. But now it's in the mid-30s, isn't it? And it's a huge change, and a lot of that is caused, leading beautifully onto the next story from the Daily Mail, is caused by the high house prices. But according to the Daily Mail, which I trust to the end of my life, not. This is the most, and I'm not going to apologise for saying that, Daily Mail. House prices could drop by as much as 30% next year, according to Nationwide. I take this with a pinch of salt. I was saying to Steph earlier, I have a feeling this was mentioned in a little, those little nuggets that you say in front of a journalist and they pick it out and go, that's my headline. So I wanted to put this in because I think it's tripe. I'm no expert, Tony.
I think you summed it up very, very nicely there. We were talking earlier about the press overhyping a story to get a headline, and this is exactly that. Because if you actually read the article, they're actually saying the balancing figure is probably 8 to 10%, which I think we're all kind of in agreement with. So it's just the absolute 30% is the worst case scenario, and that's what's grabbed the headline as ever. And it's the Mail, so what do you expect?
I think we don't generally pick on the media or discuss politics on here, but we always manage to somehow. But I agree. Carry on, Tony. I think you're about to say we're going to ask you.
No, I was just going to say, look, we've talked about this story before, and houses. My personal view is you're not going to see a bubble bursting. You're going to see a bubble slowly deflating to actually a normalisation. This is a levelling up. This is making sure that houses are doing what they should do, growing proportionately. So, we're already seeing that in the estate agency windows. I'm certainly seeing where I am, particularly, more expensive homes starting to take off 10% off the asking price within a couple of weeks. So you can clearly see that price point is being reached and people are not prepared to pay it at this point. As they were, unlike as they were a couple of months ago, where you saw a lot of gazumping, even. So I think it's coming down.
So a sharp burst from Tony there, but I'll pick up with you, Steph, on that. Do you agree? I mean, the average that I've seen, if I was to say across all the trade media that I've read, the average I've seen on house price potential drop is 9%. So Tony was right to say it's between 7 and 9%. What are your thoughts on it?
Yes, exactly. And I think this is another one of those articles where the press has got hold of a headline similar to what we were saying earlier about sort of the cost of living, etc., and they've just published it for some clicks. But certainly some scaremongering, which is a real shame for first time buyers who are reading these sorts of articles, because they just don't know what to do. Is now the right time to buy? Should I be looking to wait, to save more? And I think when you read articles like this in conjunction to sort of what we were saying before about the buy-sell stress tests, and therefore rents going up as well. So I think you still have to factor in what your overall outgoings are going to be, sort of the cost of renting long term versus putting it into a property. And I mean, the actual value of people's properties doesn't only matters on two times. So when you buy the property and then when you sell the property. So assuming that people aren't buying to sort of flip in the next 6 months, then if house price soften, then it doesn't really matter, because over a 10-year period, there's plenty of time for that to bounce back. But yes, I agree. A lot of the conversations that I've been having are potentially looking sort of that 9-10% sort of soften in terms of the house prices. But really, we've got to put that into context, because that just takes us back to literally a year ago. So, and that really is
crazy, isn't it?
Yeah. So I think people lose sight of that, because they just look at the here and now and they think house prices are going to drop immediately by 10%. And it's literally just pushing us back sort of less than 12 months of house price growth. And when people are looking at it over the long term of their ownership, it's not something that should put people off buying right now.
And that's worrying me, because I always say on this podcast, because we have a majority of brokers on here, that they will read the trade presses and take in the sensible, direct from lenders, direct from broker companies, direct from sourcing systems, and listen to the real truth. And I say stay away from the mainstream media. So any consumers on this podcast listening, get away from if you really want to know what's going on, go to the mortgage publications, like Your Mortgage, that are directed at consumers, not necessarily us broker community. But yeah, just go and have a little read, and read the real stuff from the lenders, not this rubbish that's been headlined, shall we call it. Debs, you've got a very young team of people working under you, so you must hear rattles from them. They know more than the average Joe on the street will know, because they work in the industry. Are you seeing them looking at this going, well, I'm still going to buy? Because I know, I'm asking this because I know a couple of yours have just moved. So.
They're very young. They're very young.
You make us sound like pensioners, Debs.
I think, to be honest, I think that most people, emotion always takes over anyway. I think that, there's people read articles that are in the paper, and I think that if they want to buy a house, then emotion would take over regardless. The only thing I would always say to anybody who, and I can't say it strongly enough, I mean, I was a broker for donkey's years before I came into being a BDM and then managing the team, that any consumers listening to this podcast or any podcast, you've really best advice would be to go and see a mortgage specialist, to go and see a broker, because they can tell you the best thing that you need to know about. Not only, they'll guide you on not only what is best advice for you on the product and on the term and on what you need to know, but they'll also guide you on the market. Because what you don't need is great Aunt Agatha telling you what she thinks is best in the mortgage industry, because it changes so much. When you listen to your great aunt or your parents or what they think is best on mortgages, they may not have had a mortgage for a long time, and they may not know the industry. I'm not saying that they don't. I'm just saying that they may not. So you're best off speaking to somebody who does know the industry, and they can give you a bit of guidance as to what is the best thing to do. When it comes to the team that I manage, who are younger, they know enough to be able to go to the right people. So they know to speak to mortgage brokers if they have to. They know enough to ignore the sensationalism that goes on in the press. And I think that's it. I think if you hit the nail on the head when you say read the proper mortgage industry publications that will give you a true story, because the people who've written those articles are from the brokers that we deal with all the time, that they'll know the names of, and that they're the people who have to write a genuine article because they're the people that you're going to go and speak to. They'll know Alexander Hall, they'll know all the other brokers that we speak to. So that's the best thing I can say. If you're a consumer and you know that you need to be thinking possibly next year now about getting on the property ladder, or if you're somebody who wants to remortgage and you don't know what to do, then go and speak to a specialist, because it's too important now to be thinking that you can go and do it yourself, because there's just so much going on in the world when it comes to finances. You just got to get it right, basically. It's a long time to get it wrong. It's a big financial mistake that you're going to make if you get it wrong.
Steph, that really does just, Debs has just said what I would say to anybody now, having worked in this industry for this amount of time: go straight to the brokers. But, it is true, you guys are over everything and above everything, but the media just make it worse for you, because I can imagine borrowers coming to see the broker, having a nice chat, and they've read this sensationalism. It must be the most difficult thing in the world to kind of quash that fear and anxiety that the press is generating in your customers.
Yeah, well, typically the first 10 to 15 minutes of any conversation is just unpicking what they've read and actually trying to get to the bottom of their own, what are they actually looking to do? What are their concerns? What are their longer term plans? And let's get to the bottom of that, and let's have a balanced conversation, as opposed to just those sensational headlines in the press. So, but yeah, I mean, I'll echo everybody, of course.
There's our advice. An SFI not so live piece of advice: ignore the mainstream media, read the mortgage press. If you're really concerned, go and speak to your favourite broker. Absolutely call Alexander Hall and give them a call and have a chat. No, we can't stand by that enough. So there's the advice from the podcast, which ends us nicely, or brings us to our very last topic. Now, we've lost Tony for technical reasons, so this is going to be a two-person thing, and it's short and sharp. And as funny as you want, whatever you do, by the way, audience, I did pre-warn them I was going to ask them this. So exactly 1 month today, because we're recording on the 25th of November, 25th of 11th, whatever you want to say. So Santa will be emptying his sack in exactly a month's time at the end of your bed. What do you want from him that would make your life better in your role in the industry? So there you go. What do you want from Santa that's going to fix everything? Steph?
Yes, well, like any little girl that grew up looking at the Argos catalogue and circling what I wanted, I've made a little bit of a list of this one. So I would like lower interest rates, of course. So that would definitely help everybody. Fairer procuration fees on product transfers. So from the broker's side, it is still a full advice process. We still go for exactly the same advice as we do with a full remortgage. So fairer proc fees to reflect that advice and the time given there. And on the proc fee theme, as well, fairer procs for those longer term fixed rates. So especially as Tony was saying earlier, if we are looking at sort of 7, 10 or even longer term fixed rates, then of course from the commercial view of the broker, that's a client that they won't be interacting with again over that next period of time. Of course, the advisors, we always do what is right for the client and what is the best option for the client. But I do think those proc fees should reflect the longer time that the client will be with the banks.
That's fair. And I'll let you have your Argos catalogue style list. I'm fine with that. And that brings back some memories. I remember getting a pen and writing my mum's Argos catalogue, and she would go mad because I'd circle everything and she couldn't see half the things around it, so I'd done it in a black marker or something. Go on then, James, what's yours?
I took it from the regulator point of view, and I would say that from a lender perspective, probably not have the regulator interfere so much, so that it was a stable platform for 2023. So that lenders knew where they were, what to do with them. Obviously, we've got consumer duty coming in, etc., but not to interfere. And I thought from a broker perspective, I know when I was a broker, not have the regulator change the goalposts so much, so that you could concentrate on giving them best advice without having to worry about whether there'd been other changes that you'd not taken into account, but just have that kind of level playing field.
There we go. And because I don't work in the industry, mine is better internet infrastructure across the country so we don't lose our guests on podcasts. So on that note, because poor little Tony is in the darkness and abyss of the internet somewhere. So I will take this time to thank Tony, even though he's not here for the end of the podcast. And that is time up, I'm afraid. Steph, thank you so much for joining us. The broker perspective is always a good perspective for us in the podcast. So thank you so much. And I hope you join us again.
Thank you for having me. It's been great.
Thank you to Debs, first time on the podcast, not the last time either. So I will have you back. You're not with us, are you? So I'm about to plug SFI Live, but you're not actually with us on this one, are you? Because it's a big day that I'm not allowed to talk about. But so for anyone listening to this podcast, Wednesday the 7th of December, look at your social channels and check your emails and join us for SFI Live, where I'm going to be joined by Tony and Phil. And then our naughty elf is joining for the second half, not telling everybody who that is, where there's a chance to win, for brokers to win, a luxury family hamper for Christmas to be delivered directly to your home. So it's worth a lot of money too. So we're being very, very generous. So all going on the next webinar. You can register now. If you go onto LinkedIn, look at the Saffron pages, or check me, Jay Evans, MTIPR. Just look me up and get yourself signed up to have a chance to win the hamper. Have a little bit of Christmas fun. But the first half is breaking news. So breaking that I'm not even allowed to talk about it. So if that's not a tease, I don't know what is. Thank you for joining us, and we're back again. Oh my God, we're back again in February. That's worrying, with our next SFI Not So Live, because we're not recording one in December. So we will be back with you in February. Until then, enjoy Christmas. Happy Christmas to you all. Happy New Year to you all, and we'll see you in February. Goodbye.